direction and size. I guess the direction was no big deal. Did the size of the rate cut surprise you at all?
It did surprise me. The rate cut was announced last Wednesday, 50 basis point reduction. And the lead up to the 2-day meeting on Tuesday and Wednesday of last week, there was a shift towards the end of the week before. Market expectations a couple weeks ago had generally were that the FOMC would reduce their target interest rate by 25 basis points. Then about Thursday-ish of the preceding week, before the rate cut, we saw market expectations really begin to shift, where the several days before the rate cut, there was rather than a greater likelihood, let's say a 90% chance for a 25% rate reduction, which was the case a few weeks earlier. It shifted to more of a 60% likelihood for a 50% reduction. And I think what kind of happened is as the markets absorbed the ramp down in the inflation rate we've seen really beginning in May, June, continuing in June, July, August, both the CPI reports as well as the personal consumption expenditure price index reports. One comes out of BLS, the Bureau of Labor Statistics, the other comes out of the Bureau of Economic Analysis. Both of them were showing inflation kind of moving down, the inflation rate moving back, moving down, the CPI hovering around 3%, then falling below 3%. The PCI price index approaching 2.5%. That is the measure that the Federal Reserve pays more attention to, the PCE price index. So they saw inflation really the inflation rate ramping down. Prices are still increasing, but increasing at a lower rate, closer to the Federal Reserve's 2% target. So that can think of it as the happy emoji face for inflation. Then at the same time, the unemployment rate has ramped up from the 3.4, 3.5% we saw a year ago, upwards of the 4.3, 4.2 we've seen. Then the job gains have come down quite a lot over the last 2 or 3 or 4 months. If you look at the 3-month average job gains, going back 3 months, 6 months, 9 months, we see them kind of coming down and coming down below kind of what would be regarded as kind of a neutral level of job gains, which is probably a bit over 150,000 job gains. Have kind of fallen below that level. 142,000 in August. They averaged 207,000 in the first half of 2024. They averaged 251,000 during all of 2023. So they've been coming down, and they've been coming down kind of below the level of monthly job gains that would kind of be regarded as neutral. So the point of all that is inflation has come down to kind of a glide path down to the Fed's 2% target. Still more progress needs to be made, but there's a firm expectation that will continue. And labor markets are, people used to say they're moving towards better balance. They are in much better balance. And now there were some concerns that have been cropping up of overcooling of the labor markets. And with inflation kind of firmly under control, that's one of the Federal Reserve's mandates. And the labor markets, kind of nicely at full employment without a lot of upward pressure, maybe some downward pressure, overcooling concerns. There was a shift from the 25 to the 50 basis points. Frankly, when you look at it, we knew. It's not like we knew, but it was highly expected, highly anticipated that the Federal Reserve would lower interest rates. The question was how much. And frankly, if they didn't lower interest rates 50 basis points in September it was more likely than not that they would do so at their November meeting, the next meeting. And so it's a question of, do they do it now or do they do it then? And so they chose to do it now.